Welcome to Counters. In this lesson, we'll be looking at the cash flow statement using the indirect method. We'll be going through a thorough example which should hopefully help you understand how to do the cash flow statement. So if it's your first time looking at the cash flow statement, hopefully at the end of this video, you should be able to do the cash flow statement using the indirect method. So we'll go through each example that we have here. So we are given information on the right here in white. We are given information that we need to use to do the cash flow statement. And at the bottom here, we have additional information. So always bear that in mind as we go along. We'll be looking at the additional information too. We are asked to use the information provided to prepare the cash flow statement using the indirect method. We are given the company's balance sheet and income statement. And we are given the comparative balance sheet as at 31st December 2018. It should be 2018 here. Let me correct that. So we have 2018 and 2017. And here I've put the net change, which should help us do this quicker. And I've also put the solution format for the cash flow statement using the indirect method, which should help us move quicker and to make this video a bit shorter. So we'll flow through each one. If you need to go back in the video and look at how we calculated something that you might have missed, you can do so, but we'll be going quickly through this example. So let's start with it. What is the cash flow statement? Remember, the cash flow statement documents how the company used its cash. So it looks at all the cash that the company used and how it used the cash, and it reconciles the cash basis to accrual basis. Remember, when the financial statements, namely the income statement and the balance sheet, are prepared, they're prepared on accrual basis, and that's the accounting rule of accrual. So we need to reconcile the cash basis and the accrual basis, and it's used by stakeholders to determine the company's ability to pay future cash flows, the company's ability to repay its debts, and how cash was spent in investing in assets, and how much cash was received from borrowing. So it has various reasons as to why we use the cash flow statement, or as to why we prepare the cash flow statement. Now remember, the cash flow statement only deals with the movement of cash. Only the movement of cash. So let's start. What I would like to do when I do the cash flow statement, or when I'm asked to do the cash flow statement in an exam question, the first thing you do is that if you are given the format, or if you are given the ending format, like the net change in cash and cash equivalents, if you're given those descriptions, cash and cash equivalent at the beginning of the year and at the end of the year, then you want to plug in those figures, because you'll most likely be given those figures. So in case you run out of time, at least they can perhaps give you part marks for those ones. So here we have cash and cash equivalent at the beginning of the year and cash equivalent at the end of the year. Now remember, our cash flow statement needs to balance. So what we are trying to calculate is the net cash and cash equivalents, right, over here. So net change in cash and cash equivalent plus cash and cash equivalent at the beginning of the year has to equal cash and cash equivalent at the end of the year. So let's go and look for cash and cash equivalent at the beginning of the year and plug it in. If you go to our assets section of the balance sheet, in the current assets, we will see something called bank. So here we have bank, so we know that is cash. And which one is 2017? 2017 is the one on the right. So we will plug in the one at December 2017. Remember, the figure at December 2017 is the figure at the beginning of January 2018, at the beginning of this period. So that's 22,000 there that we are given. So let's plug in the 22,000. That's cash and cash equivalent at the beginning of the year. So that's 22,000. Now let's get the cash and cash equivalent at the end of the year. Go to current assets, bank, 44,000. Your balance sheet may not say bank, it may say cash, or it may say cash and cash equivalent. So you will use that figure, 44,000. So let's go back. We'll plug in 44,000 at the end of the year, 44,000. So from plugging in those two, we know that our final figure, or our net change in cash and cash equivalent, has to equal 22,000, because 22,000 plus 22,000 equals 44,000. So if it doesn't equal 22,000 at the end of our calculations, then we know we've done something wrong somewhere and we need to go back. But it's always good to start there by plugging in those figures that you already given. So let's begin at the top. Here we have Dina's cash flow statement at December 31st, 2018, which we're asked to do. This is the indirect method. So you'll notice that the cash flow from operating activities is different between the direct method and the indirect method. So with the indirect method, we adjust the profit before taxation. Profit before taxation. Some people like to put that figure, to put the profit after taxation here, but it's good to use the profit before taxation, because we don't know if we paid all the tax for that period, or if we paid part of it, or if we didn't pay it at all. So it makes it simpler to use the profit before taxation, and in my opinion makes sense. So you will not be penalized if you use either one, as long as you balance and you do everything correctly. So profit before taxation, that's the one that we need to use. And where do we get that? We know that we get that in the income statement. So we are given a snippet of the income statement over here. So profit before taxation comes before the calculation of tax. So there is tax expense, and income from operation is 95,000 rand. So that will be profit before taxation. Sometimes it's called EBT, earnings before tax, or profit before tax. So here we have profit before taxation, it's 95,000 rand. So we put 95,000 rand, and then now we start doing the adjustment. So that's the first calculation. And what you'll notice, what I've done after each, so we have three sections here. We have cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Always have those three sections. And then what I've done at the end, you have net cash outflow. If it's outflow, it's going to be a negative, or inflow from operating activities. I've already formularized that one, so whatever we plug in here will be adding together. It will be adding automatically together and putting the figure there at the end of each. So don't worry about that. So let's look at, so we've done profit before taxation, and then after profit before taxation we have to do adjustments for non-cash items. So we have adjustment for, remember I already plugged this one here before we started with the video, so that I can decrease the amount of time we'll spend. But we have to adjust for all non-cash items, and what I saw the non-cash items to be, it was depreciation and loss on sale of equipment. Even profit on sale of equipment, remember it will be a non-cash item. It will be an income in the income statement, but there will be no movement of cash. So non-cash item is anything that does not have movement of cash, and here we are dealing with movement of cash only. So depreciation, so let's look at the income statement, because that's where we get depreciation. We can see here we don't have any depreciation given, so let's go to additional information. Okay, under A, additional information, it says operating expenses include depreciation expense of 34,000 rand, and tells us also of amortization of prepaid expenses of 2,000 rand. But we are concerned with the depreciation, so we are given a depreciation expense of 34,000 rand. So they made it easy for us. We don't have to calculate the depreciation, so we just plug in the 34,000 rand. If in your question you have to plug in the depreciation, or you have to calculate the depreciation, then there are various ways you can calculate the depreciation. If you do not know how, you can click on the suggestion on your top right now, or after this lesson. I will also have the link to how to calculate the depreciation in the comments, in the description below. So let's plug in. We are given, it was given to us, we have 34,000 rand. Plug in there, and then loss on sale of equipment. Well, I already knew that it was a loss on sale of equipment, but you'd have to determine that by yourself. If you go to number E, it tells us that equipment with the cost of 36,000 rand was purchased for cash. Okay, it's not that one. Equipment with the cost of 24,000 rand and a book value of 18,000 rand was sold for 16,000 rand cash. Now this equipment was bought for 24,000 rand and it had a book value of 18,000 rand. So we are concerned with the book value. According to our books, the equipment is worth 18,000 rand, but we are told that we sold it for 16,000 rand. So 18,000 minus 16,000 rand equals to 2,000. So we sold it for 2,000 less than it was worth in our books. So that means we made 2,000 rand loss. So we have loss on equipment, which will have, you might ask, why do we add depreciation? We add depreciation because depreciation was deducted as an expense in the income statement, so we have to add it back because it's a non-cash item. And loss on sale of equipment, it was also deducted as an expense in the income statement, so we have to add it back. So we put it as a positive. If it was a gain, we'd put it as a negative because it was added, so we have to remove it. So we put 2,000 rand there. Just extend that one. So we've done all the adjustments that we needed to do. So in your question, you'll have to look if you have any other adjustments, if you had any other sale of assets, or if you had amortization. You need to look at that, but so far we only have those two. So now that we're done with that, the next thing we do is changes in working capital. Should be very simple. Changes in working capital, I've already put them down. We have increase or decrease in inventory. Remember, if inventory increase, then we put it as a negative. Why do we put it as a negative? Because we assume that we paid cash to buy that inventory, so cash left our premises, so there was an outflow of cash. So if it's an increase, it's a negative. Where do we get those figures? We go to our balance sheet here. Remember, we are given a comparative balance sheet. You have to be given the previous year's figures and this year's figures. So we are given inventory or stock on hand. In 2017, we didn't have any inventory, but in 2018, we have inventories worth 60,000 rand. So that means there's an increase in inventory. Now, with the increase, remember, I put it in brackets, so that means it's a minus. We are deducting it. So put 60,000 rand. And then receivables. If there's an increase in receivables, then it's also a negative, because we assume that we didn't get the cash from our customers when we sold to them. So it's a decrease in our cash flows. So because we sold to them on credit, we didn't sell to them on cash. So we go to our accounts receivable. Remember, I've already done the net change between the two. So account receivable, at the beginning we had 28,000 rand receivables, and at the end we have, or at the end of 2018, we have 26,000 rand. That means we have 2,000 rand difference. So it has decreased. So if it has decreased, it's not in brackets, so we have to put it in as a positive. So we put it there, 2,000 rand. The net changes, the changes in working capital, I must just add this note. It should be very easy for you to do. You don't need to do anything complex. All you are doing is that you are looking from at the previous period and this period and seeing whether it increased or decreased. And you see if it decreases or if it has increased, whether you add it or subtract it. So you can remember this, what I put here as a description. If it's an increase of inventory, you deduct. If it's an increase of receivables, you deduct. But this case, it decreased. That means our customers paid us, so it's a cash inflow. That's why we put it as a positive. And then increase or decrease in payables, we go to our current liabilities section. So if there is accounts payable, previous period it was 30,000, now it's 33,000. That means it has increased. Now at this point, if it has increased, then we put it as a positive, because our payables, if our payables have increased, we put it as a positive, because we assume that we got more money from our creditors, or we didn't pay them, or we took more on credit, so there was no cash outflow, so we put 3,000 rand in positive. And then the next one, increase or decrease in prepaid expense. Now with this one here, prepaid expense, you may not always have a prepaid expense. So if you didn't have prepaid expense, then you don't have to put this description there. You don't have to do anything there. You'll put it only if you have it. But with these three, inventory, receivables, and payables, you will always have them. Most probably always have them. So you'll always plug in those ones. So always put in those three descriptions. So with the prepaid expense, I saw that we have it. If you go to your current assets, we have the amount here, prepaid expense. At the end of the last period, it was 6,200, and at the end of this period, it's 4,200. So it has decreased. Remember what prepaid expense is? Prepaid expense is expenses that you paid in advance, so it's still an asset. If you'd like to know more on prepaid expense, you can click on the suggestion on your top right, or otherwise I'll put the link in the description below. So it has decreased from last year to this year. So put it as a positive. So because if it has increased, it's a negative, so I put the description there. If it has decreased, it's a positive, so put it as a positive. Because we didn't use cash, we used our prepaid expenses that we had in our current assets. And then the next thing that we do is that we put these figures here. So we are now down with the with the increase and the decreases that we needed to plug in. So you can see those ones are very easy. You just need to take the figures from your balance sheet and just know when to minus it and when to add it. So now we have to add our interest paid, if we had any interest paid. So in our income statement, you can see that we have interest expense of 8,000 rand. So that's what. And then if we go down to our, if we have anything that has to, okay, it tells us in D, interest expense of 8,000 rand was paid in cash. So if you paid it in cash, remember we always have to know whether we paid it in cash, if there's any movement of cash, and there's a movement of cash there. But if you go back here, we see in the income statement, it was recorded 8,000 rand. So we're not going to put anything there. Why are we not putting anything there? Because remember, we have profit before taxation. And for us to get to profit before taxation, this 95,000 rand here, interest expense was already deducted. So we don't want to deduct it again to deduct it twice. So in our additional information, it was given probably to throw us off, to see if we understand that we do not deduct it. I hope that has made sense. You don't deduct it because it was already deducted in our income statement before you get to profit before taxation. So this 95,000 of profit before taxation, already we have that amount because interest expense was already deducted. So if we deduct it again here, we'll be deducting it twice. I hope that has made sense. And then next we go to income tax paid. Now here we are given the income tax expense of 38,000 rand, but we don't know if you paid it. Remember, our income statement uses the accrual rule. We record them when transactions take place, but not necessarily when there is movement of cash. So let's see if there is anything here if we paid the income tax. We've got land, cash dividend was paid, interest expense was paid. So we are not told whether we paid it on cash, so we assume that we paid it on cash. But if you are told that you did not pay it on cash, or you only paid part of it on cash, that is the part that you will have to decrease. But if you are not that told that you did not pay it on cash, then we assume that we paid it in cash. So we have 38,000 rand, put it as a negative because there was an outflow of cash. And also another thing to note is if we have the income tax expense in our current liabilities. Let's look at our current liabilities. We don't have the income tax liability, so that means we paid it. If we had the income tax liability of 38,000 rand, it means that we had not paid it in this period. So we deduct it as 38,000 rand because we know we paid it. Dividends paid. So let's look at dividends. If we paid any dividend, I think I saw it in the description in the additional information. Cash dividend of 48,000 was paid in 2018. So we paid cash, so we have to put it in as a negative. How much? It was 48,000 rand. So we have 48,000, and there we go. We have just, okay, so we put it as a negative. Okay, that's it. So now if I can ask you, is the net cash inflow or net cash outflow from operating activities? Well, if you can see the negative there, it's a minus 8,000 rand. That means it's a net cash outflow from operating activities. So we have a negative there, but we are done with the cash flow from operating activities. So now let's move on to the cash flow from investing activities. Purchase of equipment. Remember, I've already put these descriptions or these details because I went through it and I saw that we did purchase equipment, but you'll have to go through the additional information or go through the financial statements too to be able to see if you did purchase any equipment. I saw in the additional information it says equipment with the cost of 36,000 rand was purchased for cash. Always important to remember if it was, or to know if it was cash or credit. If it was credit, we wouldn't have put it in our cash flow statement because there was no movement of cash, but it says we bought it on cash. So equipment worth 36,000 rand. So we put minus 36,000 rand because cash left our premises. Okay, take out the bold. And then proceeds from sale of land. Now, how do you know that you sold land? Let's go to our additional information. It says land was sold at its book value for cash. Remember, land does not depreciate, so it was sold at its book value for cash. We're not given the amount in the additional information, so we'll have to get it on our balance sheet. We have land there. In the previous period it was 30,000 rand, and now it's only 10,000 rand. So that means we've sold that land, and we are told in the additional information that we sold it for cash. So we put the 20,000 rand there. So put 20,000. So 20,000 rand. Remember, it's a positive because proceeds, the proceed from the sale of land. So when we sell the land on cash, we put it as a positive. And then proceeds from the sale of equipment. Now remember, from the equipment that we looked at that we sold, and that was the only one that we sold because that's the only one that we were told we sold. We sold it for 16,000 rand cash. So when we sell it for cash, 16,000 rand. When we sell it for cash, we put it in our cash flow statement. So we put 16,000 rand. And that's it. So we are done with our cash flow from investing activities, because those were the only activities. If we had any more information, or if we looked at our balance sheet and there was a movement somewhere, we figure out if it was cash, we would have put it here. So remember, the investing activities, cash flow from investing activities mainly deal with the fixed assets, or the assets portion of the balance sheet. So here it's a dash because it's a 0, because minus 36 plus 20,000 plus 16,000 will give us a 0. So let's move on to cash flows from financing activities. Remember, cash flow from financing activities, we find them in our equity and liability section, namely shareholders' equity and non-current liabilities section. So let's look at that. Remember, I told you I did this table before, so I was able to see that we have proceeds from shares issued and we have payment of long-term loans. So how did I figure that out, or how did I know that out? Well, how did I know that? Well, without even going to the additional information, let's look at our equity section. You can see that our ordinary shares went from 100,000 from the previous period to 170,000 rand. So we have an increase of 70,000 rand. And then we go to our additional information. Let's see if there's any movement of cash. We go to our additional information. We see ordinary shares were issued for cash. Were issued for cash. So we know that the 70,000 rand were issued for cash. So whoever bought those shares gave us the cash for 70,000 rand. 70,000 rand as a positive. And then we have payment of long-term loans or non-current liabilities. So with looking at our non-current liabilities, we see loan payable of 140,000 rand in the previous period, but it has decreased in this period to 100,000 rand. So we know there's a decrease in loan payable of 40,000 rand. So let's go to our additional information again. You can see that loan was redeemable at their book value for cash. So it was redeemable for cash. So that means we paid cash to decrease the loan payable that we have. And it's 40,000 rand. We can see the movement. So we have 40,000. Oh, it's a negative because we paid cash. 40,000 rand. And then we are done with cash flow from financing activities. Now what do you notice? What will make you happy to see that it balances? So we have 22,000 net change in cash and cash equivalent. I had formularized it at the beginning. How did we get this 22,000? Well, we added the 3. Cash flows from operating activities of minus 8,000 plus cash flows from investing activities, which is 0, plus cash flows from financing activities of 30,000 rand gives us a total of 22,000 rand. So that is how the cash flow statement works using the indirect method. If it balances, then you know you got everything correctly, and you know that you'll probably get 100% for that particular question. If it didn't balance, go back and see through each calculation and see where you may have gone wrong, because it should balance. So if that has helped you, and hope it has, please consider subscribing to our channel and liking our video and sharing if you can. You can also check out other videos on our channel and in the description below. Till next time, cheers.